If you click on this video, you probably heard about the recent update to the age pension rates in Australia and you're curious on how that affects you. The thing is, most information online is very lengthy and most online channels out there don't really explain to you the impact of this. Therefore, in this video, I'll explain to you what the age pension in Australia is, I'll then talk about how it can affect you, and lastly, I'll reveal to you what you can do about it. So what are the eligibility requirements? There are three main requirements, being age, residencies, and income and assets. Let's start with age. To be eligible for age pension, you need to be at least 67 years old. In terms of residencies, you must be an Australian resident and have lived in Australia for at least 10 years. And for at least 5 of these years, there must be no break in your residencies. Regarding the income and asset tests, there are two separate tests and they both determine your pension amount independently. Once you get these two amounts determined, whichever one that is lower will be your pension amount. For example, let's say if you have $1 million in asset and earn $30,000 a year, the asset test would say you're eligible for $0 in pension amount, but the income test says you're eligible for $500 in fortnightly pension payment. In this case, the lower amount, which is 0, will be your pension payment. I'll explain each test in more details later on. But before we continue, if you guys would like more insights and tips on real estate, properties, personal finance, stocks or crypto, make sure you subscribe to my newsletter in the description down below. Now let's go through the pension rate updates. From 20 March 2025, the maximum full age pension increases $4.60 per fortnight or $119.60 annually for a single person and $7 combined per fortnight or $91 annually for a couple. So, what is the maximum rate Australians can earn? For the period 20 March 2025 to 19 September 2025, a single person can get $1,149 per fortnight or $29,874 per year, while couples get $1,732.20 per fortnight or $45,037 per year. Now that we know the maximum age pension one can receive, let's look back to the asset and income test to see how much pension can be reduced by those tests, starting with the asset test. The threshold for full pension, which did not change this year, is as follows. For singles, it is $314,000 for homeowners and $566,000 for non-homeowners. For couples, it's $470,000 for homeowners and $722,000 for non-homeowners. If your asset level is above this amount, your pension payments will start getting reduced. For every $1,000 in asset that you exceed, you receive $3 less per fortnight for singles and for couples. This amount will keep getting reduced until you meet the cutoff limit. This is $697,000 for homeowners and $949,000 for non-homeowners. For couples, it's $1,047,500 for homeowners and $1,299,500 for non-homeowners. So overall, not many changes for the asset test. When you look at the income test, similar updates apply. If you're a single person and you earn up to $212 per fortnight or $300 if you're still working, your pension will not be reduced. However, once your income starts to exceed that level, you'll start losing 50 cents for each dollar over $212. For couples, the full pension income threshold is up to $372 fortnightly, and for every dollar the couple earns that exceeds that threshold, the pension payment for each member of the couple's pension will be reduced by 25 cents for every $1. And the reduction will continue until it meets the cutoff point, which is $2,510 for a single person and $3,036.40 for a couple. Now, if you have some money in financial assets, make sure you listen up very closely to what I'm about to say, since it will directly affect your pension payment. For financial assets, so your bank accounts, shares, and supers and others, Centrelink enforces this thing called Deeming Rates. These Deeming Rates are to be used to estimate the income you're earning from your financial assets. Funnily, instead of using your actual investment returns like how every other institution does, Centrelink uses these rates to calculate your deemed income. This deemed income is added to the income in the income test to determine how much age pension you're entitled to. For example, if you have $1 million in financial assets and the deeming rate is 0.5% or $5,000, then this $5,000 will be added to your income for the income test. So, what are the different deeming rates? For singles, it's 0.25% on the first $62,600 of your financial assets, and then 2.25% on any amount above $62,600. For couples, when at least one partner receives the pension, it's 0.25% on the first $103,800 of your combined financial assets, and 2.25% on any amount above $103,800. The deeming thresholds mean that you now need to consider how you structure all your investments for optimal benefits, whether it be through a trust or a company or under another family member's name, etc. etc. These can all be recommended to you by a financial planner or an accountant, so make sure you contact them. One final note before I end this video: if you now qualify for age pension, you will have access to the Pensioner Concession Card, which can provide you with cheaper healthcare, medicines, and some discounts. And with this video, I want to highlight that even though with this channel, I talk a lot about ways to improve your finances, I don't really think finance should be the main thing to focus on in life. Enjoy the journey, play the game, but devote your life to more important things. To quote Mark chapter 8 verse 36, "For what does it profit a man to gain the whole world, but forfeit his own soul?" Well, there you have it. Do let me know what you think about this issue in the comment section down below. And if you want to see further insights about the market of real estate, crypto, stocks, and the cycle, make sure you subscribe to my channel because I'll be revealing the rest of my insights very soon.